Hi, my name is Paul Guttridge, and I am Senior Advisor at RI Advice Newcastle Lower Hunter. This video is to provide you with a high-level overview on what is superannuation. Please note, this is general information only and it does not take into account your personal circumstances. As financial advisors, we talk about superannuation a lot. So what is super? The Australian government set up the Superannuation Act in 1992 to encourage Australians to save for their retirement. Super is simply another tax structure to tax effectively save for your future. So what do I mean by that? The average individual pays tax at a marginal rate of 32% plus 2% Medicare. So let's say 34%. Large companies pay tax at 30%. When you're contributing to super, so an accumulation phase, the super fund pays tax at 15%. But when you get to retirement, the tax rate for pension accounts is generally 0% tax. So a significant tax saving when you hit retirement. Just an interesting fact, there is $3.3 trillion invested in Australian superannuation funds as at 30 June 2021. By 2030, 8.5 years away, this is expected to be around $6 trillion. So almost double. Significant amount invested in superannuation funds. Besides property, for example, your home, super is likely to be one of your biggest investment you will ever have in your lifetime. There are three main choices of super funds. Defined benefit, which is a very restricted option, and there's 26% of superannuation is in defined benefits. Self-managed super fund occupies 24% of super funds. Industry and retail funds have about 50% of the superannuation industry. So which super fund is best for you? Now, there's no right or wrong answer because it depends on you and how you would like to invest your retirement savings. This money is yours, so you need to decide how you wish to invest your money. There are many different ways to invest your superannuation monies, which include bank accounts, term deposits, shares, and property. Generally, while you're working, you contribute to super in a variety of ways. The most common one is the super guarantee, where employers are required to add at least 10% of your gross wage. Over the coming years, this will increase to 12%. Other forms include salary sacrifice, personal contributions. Now, they could be tax deductible or non-tax deductible. There's also spouse contributions. So the biggest question we get is, when can you access your super fund? And it's one of the biggest downsides to super. Generally, you can't access it until you meet what's called a condition of release. Often this condition of release is when you stop working after age 60 or when you reach age 65, whether or not you've stopped working. When can you access super? When you can access super, you generally start to draw an income. This is to help support your retirement lifestyle, basically the effect of replacing your employment income. What are the key benefits of super? Forcing you to save for the future and be self-funded and not be so reliant on the government. Compounding effect of investing. Tax incentives for higher income earners by doing extra super contributions, like I mentioned before. Government incentives for low income earners. But most importantly, the biggest is the tax benefits once you reach retirement. In summary, this is your money and you should take note of it. There are many strategies available to use and they can become quite complicated, and therefore highly recommend you speak to a financial advisor. And if you're unsure what the next steps are, or you wish to know our process, please refer to the video where Gil Gordon talks about our process. Otherwise, feel free to give our office a call on 4933 01 00 and book a time to have a quick chat with one of our advisors and book in for a first appointment. Look forward to seeing you. Bye.